Well, John and Fritz both alluded to investment opportunities and also cautions. So let's turn now to commercial real estate investing. Rebecca Wells, Vice President, Investment Services Group, will share with us the insights of two national figures on the immediate future of commercial real estate. Becky, the stage is yours.
Thank you, Gary. Well, 2009 was certainly a tough year for investment real estate. So this year, in light of current economic conditions, we thought it'd be important to bring you a national perspective on the investment market. We traveled to our office in Washington, D.C. in order to meet with the heads of our Capital Markets Division, Bill Collins and Christian Miles. We sat down with Bill and Christian to get their insight on what they saw happening in 2009, as well as what they see for 2010 and beyond. So let's take a look at what they had to say. So Bill, thank you for taking the time to sit down with us. Let's get right to it. How did the volume of transactions in 2009 compare to prior years?
The number of transactions are down dramatically right across the board. The sales volume for 2009 is going to be somewhere for the total commercial market of about $46 billion. And that compares to $146 billion in 2008. So we're down about 67%. The peak of the market, I think, is probably more interesting. The peak of the market, we were about $450 billion worth of transactions. So we're down basically 90% from there. The average, though, when you take a look at the 2000s, you're basically looking at about $200 billion worth of transactions. And I think that there's a good chance that we'll end up recovering back to that normalized level.
Well, it sounds like, based on what you're saying, that transaction activity will increase in 2010?
Well, I think we're starting at such a low point that the answer to that is yes, it's going to increase. But I think there's some fundamentals that we're seeing in the market right now that are showing that in fact, we have started that movement. I think in 2010, what we're going to see is many of the distressed sellers, special servicers, bank REO departments, and the like are going to start to have to dispose of the properties that have been accumulating on their balance sheets. In addition to that, we see private sellers, people who have bought property probably in the early 2000s, are starting to see pricing and figure that they're near the historic averages. And so I do think you'll see a real lift in the activity level. And I think pricing, though, is something that we've got to watch. I think pricing could end up being flat in 2010 and 2011 because the situation with the supply and demand, meaning that there's going to be much more supply coming to the market, and there's still a lot of pent-up demand, but we just don't know how deep that is. So again, I look at 2010 and 2011 as good years, pricing being pretty good, but if you have a situation where there is a tremendous amount of product coming to the market, that could actually send pricing down a little bit.
What do you think the buyer profile will be like for next year?
The buyer profile in 2010, I think, will be very similar to 2009. In 2009, between private equity and private individuals, they accounted for about 60% of all the transactions in the U.S. We think that will continue. The driver behind that is a lack of debt that we all read about and know, so that you have to have 40+% in many cases equity in order to leverage your property. And debt, when you look at it, still is the driver for our market. So you have to have equity with a little bit of debt out there. And so I still see that happening. The other places that we're seeing activity will also be from both the public and private REITs, the public markets. I think they're still very accommodating. And another group that we see on the all equity side is really pension funds. And those pension funds actually still are interested in properties. The type of properties they're interested in are more core, and those properties probably have a value range under $100 million. So again, smaller transactions will probably be the banner. All equity or very low leverage type buyers will also be part of that group.
So Bill, what are some of the signs of recovery we should look for in 2010?
Well, the signs of recovery, I think, are the things that we've been reading about here recently. I think there's three different categories that I'd look at. One, jobs. I mean, all important. You have to have job creation in order to have demand, whether that's for office space, industrial, retail. So jobs being a big part of that. Consumer confidence also, and consumer confidence / business confidence. And we've watched those indicators, and confidence has more than doubled from 12 months ago. So that's another very, very good sign. And then third, the part of the component that we're talking about is we have to have a return of debt. And we're starting to see signs of that. I mean, a couple of the recent CMBS offerings that have gone off here recently are good signs. I would say that that's a thawing. I wouldn't say that that's a flood. So, if I wrapped it up into three categories I'd watch, again, jobs, consumer confidence, and debt.
Christian, we heard Bill say that the activity market and the debt market is more like a thaw than a flood. What do you see happening in the debt and equity markets in 2010?
Well, 2010's got a number that are coming up that I think are pretty important. First is just an end to the denial. There are losses. Everyone acknowledges that's happened. I think the REITs were one of the first to understand that. Certainly the public markets told them so, and they took steps to rebuild their balance sheet as a result. A number of the pension funds have acknowledged them, but not all. I think there's probably a little bit more there. Certainly the banks, they're having a tough time acknowledging them, and that'll be a big hurdle for 2010. Probably one of the great promising lights is that the CMBS market is going to come back. I see the TALF program run by the Federal Reserve, was very useful in a lot of the other financing markets, and now has proved to be very helpful in the commercial mortgage market. And we've had these recent transactions that have been very impressive, pricing much lower than anyone expected. And all the major banks in New York have now announced that they plan to get back into the CMBS market. I think it's very positive. We have a lot of older CMBS bonds out there, and we got a lot of bank debt to work through yet. And that is unresolved. The CMBS debt is still going to be extremely difficult. You've got all these various bondholders warring with each other, trying to wrestle some control and get some leverage. The opportunity funds are sitting and waiting for the opportunities when these properties finally do foreclose and go to sale. But heretofore, we haven't seen the volume. I expect to see more volume of that kind of sales in 2010. One of the great things that's happened in the debt markets was the quick resolution of General Growth's bankruptcy. And one of the key points in that is that the bankruptcy remote entities that were created when General Growth went in came out intact, which meant that some of these bankruptcy protections that lenders thought they had, they kept. They hadn't. They withstood the bankruptcy test.
Any thoughts you would like to leave us with regarding the investment market?
I just like to remind folks that with all of that public debt, with CMBS, with the REIT business, there's a lot of statistics out there. And frankly, I just want to let the folks know that with all those statistics, people will be assessing risk in a new way. You'll see new phenomena as a result of this statistical analysis that'll come with that. I think the Midwest markets should be ahead of the curve on that, in the sense that they should look very hard at how their markets performed during the downturn. For example, the industrial markets in the Midwest all had much lower default rates than a lot of other product types. I think there's an argument for a lower risk because of less volatility in the Midwest, and I think that we should be first in line to make those arguments, because the lenders will appreciate that. And I think they will price their products accordingly.
Thank you to Bill Collins and Christian Miles from the Capital Markets Division.
Certainly always useful to hear the perspective of experts from outside of the state of Indiana, even though we don't bounce around as much as some of the other markets. What happens elsewhere obviously does affect us here. So, Becky, thank you for bringing those insights to us.